Hello and welcome to the part two of Sources of Finance, where I'll just be finishing up with the rest of the external sources of finance. So let's dive right into it. So the next one is overdrafts, which is a financial service allowing a company to temporarily withdraw more money than exists in their account. So for example, if you have a bank account and you want to purchase something um, that is expensive with your credit card, for example, but you don't have enough money in your bank account, if you just purchase the item, you'll have an overdraft because more money got taken out of your account than you actually have. And that's also an external source of finance. This is, of course, a type of short-term loan, and you could also say it's a loan capital. And it's sort of an emergency access to finance because usually you wouldn't want to take this source of finance because interest charges tend to be very high on overdrafts. So it's not really sustainable in the long term. The next one would be trade credit, which enables a business to obtain goods or services from a supplier without immediate pay. Meaning, if there's a grass mower company, let's say, and um, you you ordered them to mow your grass, but you don't have to pay them immediately. You just pay them in a month or two. That means you received the service, but you haven't paid um, the invoice yet, meaning it's an external source of finance. It's usually between 1 to 2 months, making it also a short-term source of finance. And it often means that the business misses out on a potential discount. So what often happens with businesses, they'll give the business or the supplier, so the supplier will give the business a discount if they pay the full amount immediately. But if you do the trade credit, you take on trade credit and you pay them a month or 2 months later to have better liquidity in your company, you will miss out on that potential discount. The next one is hire purchase, which is an example of trade credit involving paying for fixed assets in regular installments. You got at on an individual level, you got it often for cars, for example, where you buy a car, but you don't really buy a car. You pay a company every month or so in installments um, for a certain period of time, and at the end, you will have paid the whole car, paid for the whole car. So the finance company retains ownership of the asset until the payment of all installments, which thereby legally transfers the ownership over to the business. So only after that last payment of installment does the asset does the ownership transfer to the business. In the aggregate, like one disadvantage of this could be that in the aggregate, all the installments together, it's usually more expensive than the current price of the asset if you would just buy it immediately now. The next one would be grants, which is a financial assistance granted by the government to qualifying businesses to aid or slash and support their operations, such as startup businesses and their research and development. It's often there to reduce production costs or to encourage employment opportunity in less economical regions, or also economical industries if you want, but usually regions. And it is usually only available to few and smaller businesses. So it's usually not something big businesses or medium-sized businesses just have access to. The next one would be a similar like the grant, it's subsidies, and it's also provided by the government or by government entities to encourage output, often in a given industry. What this means is that, example given, there would be one example of this are the public operators public transport operators, sorry for that, being subsidized in many countries to reduce operational costs and therefore the prices for the consumers. It usually helps stimulate, or that's actually the goal, that it stimulate investment that would otherwise be too expensive. So if you think about public transport, companies might not go into that area building a whole metro or subway station, subway railway, because it's a huge investment. But if they get subsidies, they could keep the prices at the end for consumers low while still making that investment. Also, large businesses taking subsidies may lead to controversy because it's seen as unfair, so that might be a disadvantage. The next one is debt factoring, and debt factors take over the debtors of a business by paying the majority of it now. So what this means is, well, first of all, debtors are customers that owe the business money. So a debt factoring business would come in and pay the business now, taking over the debtors and charging around 20%. So what this means is, for example, if you're a business and you're a catering business and you just catered a wedding, but the people who bought your services and food, they are only paying in 2 months. Basically, they're taking on trade credit. So for the catering business, those are debtors. But what a debt factoring company would do, it will pay a majority of that amount, of the catering amount, directly to the business, while charging around 20%, taking over the debtors and basically chasing them by themselves. That means it takes off the debt factoring business takes off the work of the business that is not in the business of chasing other people to pay them, which can increase efficiency. And although this may improve liquidity in the short term, it also takes away a significant amount via the charge, because the debt factoring companies usually take a lot of charge, such as around 20%. The next one is leasing, and most of you guys would know it. It's a way for a business to finance fixed assets without the necessary capital expenditure. So a leasing contract makes the business pay a monthly fee for a fixed period, and in exchange, the business is able to use the fixed asset without having to maintain it, because the responsibility of maintaining the fixed asset is still with the leasing company. So this might be an advantage for the business. One thing to remember, though, is that the fixed asset is not the property of the business, which may hinder possible plans. And what I mean by that, it's a bit weirdly phrased, but what I mean by that is, if you have a machinery and you want to, but it's not yours, you don't have ownership of that machinery, but you want to change it, you want to make adjustments to that machine, you might not be able to do it because you don't actually own it and you'll have to give it back someday. So that's something to think about. The next one would be venture capital, which is an investment firm that invests in business startups. So the venture capital, the term means the investment made in those business startups. And venture capital may represent the combination of loans and share capital. That means that it's probably going to be long term, because if they take share capital, the venture capital firm, they're going to stay in for the long term, and it's going to be permanent finance for the business startup. It is useful for businesses that have difficulties or are unable to raise finance through bank loans or stock market. So through like those usual mediums. If a business, for example, is too small, a bank or the stock market may not suffice for their appetite. The next one would be, and I believe it's the last one too, it's business angels, which is close to the venture capital idea. Business angels are wealthy individuals investing in high risk and high growth potential business projects. So what this means, it allows finance for small businesses that don't have access to conventional sources of finance, such as banks. So the same idea like in the venture capital source of finance. Just in this case, it's wealthy individuals that take all their risk because they put in their personal fund into this. It is usually a long-term option as the business angel more or less commits for months and years into this project or into that little startup. And often it also comes, like in the case of venture capital, it also comes in the form of share capital. So they're going to take some kind of ownership position into that business project, into that business. One important thing to consider with all these sources of finance is that a business or businesses should match the type of finance to its use, meaning long-term finance should be used to fund expansion and growth, so long-term plans, while for example short-term finance should be used to dampen fluctuations in cash flow or to finance daily operations, meaning short-term actions. So this is always important to keep in mind which one is short term and which one is long term or medium term, because it often appears in business. It often like the IB likes to make questions about sources of finance about this exact thing. So for example, they're going to ask you, they're going to give you a case study, and then they're going to ask you what would be two suitable sources of finance for this specific sole trader or whatever company. I hope this helped you. Please, if you have any feedback or questions, comment down below, and thank you for watching.